Welcome to the Family Office Sherpa podcast. I'm your host, Shaun Parkin, founder and managing director of Whole Road Investments. The aim of this podcast is to provide practical and implementable advice for those looking to build, manage, or service a family office. This is not, however, investment advice, so please check the disclaimer in the show notes. And for anyone interested in the Whole Road platform, what it looks like, what fees and services and engagement types, please reach out to Shaun, S-H-A-U-N, at wholeroad, H-A-L-L-R-O-A-D.com.au. In this episode, I'm going to cover: will your office survive change?
This is the Family Office Sherpa.
I meet a lot of offices that, on the face of it, seem incredibly robust, incredibly well run. But one of the reasons that Whole Road is brought in, or some version of advice or extra structure and advice is required, is because once you scratch the surface, such as, a change in generation, a key person moving on, changes in the family dynamic, a key advisor changing, all these sorts of things, you can see that resilience and the actual robustness of the office is not quite as strong as they thought, to the point where sometimes it requires a whole new like a diagnostic or some version of that, right? Which is a lot of the work that I do, right? Which is I come into offices and we produce a diagnostic of some description, which basically means how robust is this office? How structurally sound is it, right? So the aim is to build structure that can withstand these changes. I mean, we talk about risk, investment risk a lot of the time, tax risk, things like that, fraud, all these sorts of things. But I guess what people tend to miss a lot of the time is how much risk is involved, is actually in the structuring of the office, in the scaffolding, if you will. So I thought I'd outline some points to think about, and with a couple of really specific examples around, what we thought and what was actually true. So what's the big mistake? The big mistake is building infrastructure for what you'd probably call static office, right? We see a lot of offices build their infrastructure, such as the systems, the reporting, service providers, as though the office will look the same in 5 years as it does today. And there's not curation for change, right? So, and then what ends up happening is you get a lot of offices that might be locked into processes or key parties or key people that are hard to extract and also aren't built for 5, 10, 15 years down the track. I'm not saying you need to be able to see into the future here. I'm not saying, don't let, analysis paralysis get in the way here. Like, you do need to make decisions. You do put services and counterparties in place, but just have a thought around, well, okay, what happens if this changes? What happens if this changes? Just we're not talking simulations or anything, but just certainly go, well, what would happen if this happened, right? Because families aren't static. Asset mixes change. You might get a new investment person come in, or the family decides that a certain type of asset class is more important, which we do see in particular in generational change. And, that changes the asset mix, which can make massive differences to the way that, we report, where growth, bursary, distributions, things like that. Another thing is that the family structure might change. Next generation comes in. New trust structures might be put in place. There might be liquidity events. There might be there might be big expenditures, right? We sometimes see that when they purchase new buildings, or they'd be not new buildings, but new businesses or other big assets, like buildings. Things like advisor rotation and complexity almost always increases before it decreases. So having a mindset for when you structure your office that, it's not complex now, but complexity tends to follow, especially if a lot of the clients that I work with that are just post liquidity event, or they're just getting structuring in place, things get more complex, and building a structure that allows for that is really, really important. Another thing is infrastructure built for a simple office often can't handle the office once it gets more complex, right? And what I mean by that is not necessarily more moving parts and all the rest of it, but if you're getting more, let's call it sophisticated, and you want certain outputs and things like that, or you want to manage things differently, then that infrastructure build needs to be, I don't want to sound like a wanky here, but like mobile or interoperable, or choose your word, which means just because we built it like this for this output doesn't mean we're not going to, we need to be able to build on that rather than having to restart completely. And the other thing is, when did you last stress test the operating model here? And sometimes, honestly, what I see is the best stress test is when we have new staff come in, because they come into it and they go, well, I don't understand this, or I've seen this done differently, or something like that. That's actually a really good stress test. New CEO, new investment people, new admin, you name it. Like, that's actually, I would say that's probably the best way to sort of have someone come in from the outside and look at the way it's structured and go, I can see where this is potentially going to have some challenges. And a lot of time, to be honest, that's where whole row fits as well. So it's just sort of, I think that sort of just creates sort of an idea here, which is, what are the things that maybe if you're looking at your own office, how can we at least look at a review, or like I mentioned, diagnostic. Next one. So reporting is not the goal. The operating framework is. I found that a lot of offices with a really good aggregated reporting, that's not the objective here. The objective is never to have great reporting. The objective here is efficient operating. Like I've mentioned in the past, the central purpose of good reporting, when I talk about reporting, is like aggregation of assets and some version of being able to see everything at the asset class level and all the rest of it, is to provide good advice. That's what it's there for. That's not the goal. The goal is not pretty pictures and nice tables. Admittedly, that is quite a nice feeling when all that comes together. But that's not the goal. The goal is not to have nice reporting. The goal is to have reporting that can be useful, and also it fits within the infrastructure, right? So this whole idea, and I just read an article recently, which I'll put in the show notes, which is, a dashboard is not your operating infrastructure. We see things like, we can see everything in one dashboard. It's like, okay, great. But that's not proof that the job is done. It should be treated a lot of the time as the starting point, right? We've got this. Reporting job is to create advice, to prompt decision, not to produce what you call a book of record, right? Otherwise, because it doesn't mean anything. So that's something to think about. I think if you look at your office and go, no, I know exactly where it is. They've got a really cool dashboard. We know where the assets are. We know all this sort of stuff. You go, yeah, but what happened? Like, that's really easy to. No, I don't think that's the sign of the robustness that we're looking for. If every report, your office produces, you got to think about, what decisions did this change last quarter? Like, what if the answer is none? It's just a record keeping piece, right? Like I said, it's got to be advice. The other thing, and along that same sort of lines, visibility, like being able to visually represent the office, is not control. The dashboard aggregates everything into one clear view. It makes it easy to look at, but it doesn't make it well run, right? It's easy to mistake that for good management because it looks organized, right? Clean formatting, consistent numbers, everyone in the meeting agreeing. But control means exceptions get flagged. So if you have this great dashboard and all the rest of it, and goes, well, that looks great, we know what we're doing, but nothing comes from it. So there's no exceptions being flagged before they become problems. If there's ambiguity around who owns which process, and what we're looking for is that the framework behind the numbers is sound, not just a presentation of them. Okay. One case in point, I said I was going to put some examples in here, was commercial property, right? So commercial property, there's a couple of instances where I've seen this, which is reducing the commercial property holding. So we cut the position or the investment, and it was very clear, like the amount of effort going into manage that particular asset should improve the operational efficiency, or it should simplify it, right? But it didn't look like that in the dashboard. So the dashboard said that there was still a lot of these data points and things like that, but we were going, well, shouldn't this be simpler? I thought this was the whole point. The dashboard showed an asset allocation percentages and things like that, but the dashboard doesn't show all the just the minutiae underneath it, right? So what I'm getting at is the dashboard looks like commercial property A, this is what it's worth, this is what we paid for it, this is the monthly yield or yearly yield or whatever you want to call it, right? And you go, oh, okay, that's good. And then when we sold it, a lot of people went, oh, this is sort of 3 data points that we don't have to manage anymore. But it doesn't look at all the underlying complexity, lease renewals, tenant management, insurance, valuations, I mean, if anyone invests in commercial directly understands. But I guess what I'm getting to here, without sort of belaboring it too much, is what was shown doesn't necessarily show the amount of effort to get to that point. And it goes back to that whole point, which is a dashboard doesn't mean the business is running well. Because even though it might have looked really nice, there's a lot of crap underneath it. There might be bad tenancy. There might be bad record keeping. There might be tax gaps. There might be all sorts of things. So what I'm getting at, especially with commercial property is a good example, is that you've got to be really clear around each one of the investments and assets and things like that from a process and when you have your quarterly meetings and things like that on an operational point, not just the investment point. And maybe that's really the crux of this whole thing. What's our operational meeting look like as opposed to our investment meeting? Because sometimes that's where all the bodies are buried and things like that. Like that's where the things that are going to pop up and be really high risk. So the true operating cost of a position is rarely proportional to its dashboard weight or some version of that. Again, it looks great on a dashboard, but it doesn't really show you the underlying complexity, right? Another example is private markets. We all know that private markets are becoming bigger parts of our portfolio. Private markets, honestly, look kind of simple. You have a one line. A lot of the time it's one potential transaction, right? So we invested in this. This was and then there's one line, and then this is what the current price the valuation that we've got, if we've got one. If it's with a fund manager, there might be some version of NAV or something like that. But what it doesn't show in terms of this hidden operational cost is sourcing and adding the position, right? If it's a fund, there's application redemption. It's not nearly as bad. But if it's a direct position in the private market space, what does the legals look like? What is where is that document kept? All that sort of stuff. Legal and DD, capital call administration. My God, that is a real punish a lot of the time, which is to a certain degree why some of the smaller offices are moving towards evergreen structures so we don't have to deal with that. But like building up that whole process and policy of private markets is, again, I don't know if people really clear on the risks and the amount of effort that goes into managing these sorts of programs, right? So ongoing valuation and audit, tracking commitments versus capital calls. I mean, it all adds complexity. None of it shows up in the dashboard. None of it shows up in the pretty picture, right? It doesn't show up as the staff time, the advisor fees, just a load that you have to take on for tracking these commitments across things like vintages and all these sorts of things. So this is exactly the kind of cost a presentation or a dashboard doesn't illustrate, right? And I think the reason why I'm bringing these two up is because these are the two where I see a lot of people, especially on the at the higher level, not on the operational level, that see it as being like, we need to invest in private markets. And you go, okay, but these are the costs associated with it. It's like, oh, okay, well, I didn't realize that level. I mean, sometimes a diagnostic of the office is about, wow, let's break it down to how much time we're spending on it, right? How much time is staff, are we advisor fees and all this sort of stuff. Like that's really, really important for us to pull out when we do these sorts of diagnostics. So let's move on. Right. So what's hidden behind the dashboard, right? In its clearest sort of ways, right? Before the dashboard is put up, you got to ask things about the true cost to administer each position, not just its return on weight. Who owns each process from the start to the finish? Who's accountable when it goes wrong? Not who reports on it, right? How exceptions surface. So are they flagged as they happen, or are they only noticed in the next scheduled meeting? That's a really important one for me, because what this is why I tend to avoid, if I can, quarterly meetings, because quarterly meetings mean that it would take 3 to 3.5, 4 months before anything can be flagged if no one's got their hand on the tiller, right? So we do see some offices where we go, it's quite an outsourced model, or it's a model where a lot of the work is being done by our counterparties. And so therefore it's really, really hard to sort of track down breaks, track down things like, oh, hang on, we're selling that, we're buying that. I don't really understand. You know what I mean? Like, it's really, really difficult. That's why I tend to avoid quarterly ones. But, a lot of the time, if the process is running really, really well, but who owns it? Not only who owns it, but who owns the monitoring and the management of them, who will see those exceptions or those issues bubble up before everybody else does. And sometimes that's why it's often really good to get a CEO or some sort of operational person that has oversight over all these things. Some of the best improvements I've seen in offices is when a real true to label CEO is hired or is brought in. So that's really the challenge for a lot of these things. So what happens between reporting periods? Don't have it all, the burden entirely on finance. Don't have it all on the administration, because sometimes that is about that's being reactive rather than proactive around these sorts of things. So, like I said, but none of that's going to show up in your aggregated view. So, what am I saying? A good dashboard reflects a well-run office, but it doesn't create one. Right? That's pretty much it. So, look below the surface. I'm a massive fan of double-clicking on stuff without sounding, like that guy, which is, I like to sort of go, well, where does... I'm really on the investment side here, which is what we're talking about. It's like, okay, look at that transaction. Let's dig into it. Let's understand not just the output on the quarterly or the monthly, but I want to dig into that. I want to dig into the transaction. I want to know what we paid for it. I want to know how often there's been transactions in it. And I found one today, which I thought was a bit interesting, which was the investment advisor has allocated to an exchange-traded fund. And we gave that instruction, and it took them ages to implement. And I'm like, I don't understand. It's an ETF. Get them to put more liquidity into the marketplace, and we can hit it. I don't know. We just sit there, best bid or something. I'm like, no. It's a ASX 200 or S&P 500 ETF. Just get the market maker and the authorized participant to put more liquidity into it, into the market, into the screen, and then we can hit it. Oh. Okay. It's just stuff like that, like stuff that I would have thought operationally would be really simple, but people do need some insight. And I only found that out because I double clicked on the position and went, oh God, this is taking forever. Anyway, one of the things that we do, is pick one position or process this week and ask how it actually costs to administer. So a good example is, like I said, commercial property and private markets. From start to finish, what was the level of, cost to administer that and continuing cost to administer it? And then we have a think about it. It's like, do we want, is the compensation of return usually or diversification worth it? Is the juice worth the squeeze? A lot of the time, right? Is not, because we're adding complexity and stuff like that where it just costs so much and there's so much risk embedded in it. And we're actually not actually building out a good program because we're not on top of it. So anyway, that's what I thought I'd do, because I'm seeing it a lot, right? Which is operationally, it looks great on the monthly and quarterly meeting. But when you dig into each one of these positions, when you dig into each one of these operational, complexities, we really just go, well, this is one bad decision away from a real issue. And I guess that's what I'm getting to. Hopefully it was interesting. If you're enjoying the podcast, please ding the little alert bell. And if you want to rate it, that's great. It always looks better when there's ratings. So, and you'll get a notification when the next one's published. If you're interested, please visit the website, thefamilyofficesherpa.com, where you can see podcasts, newsletters, guides, and videos. Till next time, thanks for listening.